Chapter 1, An Introduction to Accounting and Business. These are the learning objectives for this chapter, and as a student I never paid attention to these things, but I'd encourage you to get some expectations set up in your head and figure out what we're going to be doing at different places. This first presentation is on just these first two LOs. Describe the nature of business, the role of accounting and ethics, how those things fit together. And then next we'll talk a little bit about the development of accounting principles and relate them to practice. And accounting is a lot different than you think. It's not just addition and subtraction, and it's not black and white. It's all judgment. So you'll get an introduction to that in this chapter. We'll talk about a few technical things here in the next section on the accounting equation and defining each element, and then how transactions that are recorded change the elements of the accounting equation. Okay? So first the equation, then we'll add transactions, and then finally you'll be able to produce financial statements. So that's a pretty tall order for a first chapter. This is no blow-off chapter, believe me. It's not like the first chapter in a lot of books. This is a solid one. So a business, all right, and one word aside, that each one of these topics looks at the top of a bigger area. So what you're getting is an overview, but you should have a concept when you're done, okay? So a business is an organization in which basic resources, inputs, like materials and labor or people, okay, in a service business, are assembled and processed to provide goods or services. That's the output. So the objective is to earn a profit, and that's the difference between the amount you receive from customers and how much you put into the process. Here as an example, 3 broad categories of types of businesses, and we've got service, merchandising, and manufacturing. Okay, a service business provides service, like Delta provides transportation and Disney provides entertainment. A merchandising business provides a merchandise, a product, and the best example is a box store. Think of Walmart or Amazon. But then a manufacturing business takes materials and labor and people, and adds work to things and produces goods. So you can think of Ford Motor Company, their product is cars and trucks, or Dell, their product is personal computers. So 3 businesses, right? Service, merchandising, manufacturing. And the role of accounting in all this is accounting is really an information system that provides reports to users about economic activities and the conditions of a business. Okay, it puts quantitative measures on events. So, and what accounting does is identify a user, assess what their needs are, design a system to meet their needs, record the data, and prepare a report. And the users are not just people on the outside like investors, it's also users internal inside of a company, okay, like management. And here's their illustration of this process. And the only thing I'm not really crazy about it, but I like this piece. The inside, the internal users are all the people that need accounting information within a company. Okay, this is kept privately, within the company. We don't share this with outsiders. Versus external users, and that would be investors, creditors, customers, the government. Okay, they get standardized accounting information. With managerial is what we'll study in this course, and that's the area of accounting that provides internal users with managerial accounting information. Okay, and managerial accountants, they're employed within the business, and this is considered private accounting, as opposed to financial accountants. This area of accounting provides external users with information. Okay, that's financial accounting, and the objective is to provide relevant and timely information to help people make decisions. All right, and one of the vehicles we use to do that is a general purpose external financial statement. Okay, and that's distributed to external users. Now, ethics is important because, you might think that that this information is really straightforward and it's just money, cash in, cash out. How difficult could that be? But there are a lot of judgments involved in accounting, and the accountant really is the first line of defense toward providing timely, accurate, correct information for a decision maker. Okay, so accountants have to behave ethically and be trustworthy so the information is useful for making decisions. So you can think of ethics as moral principles that guide the conduct of an individual. Now this is a good slide, but it's in your book. It's in the book, and it's a little, I think it's kind of small to see here, but these are examples of business frauds, and I'm sure you've heard of some of them for sure. Enron, it was biggest ever, that was $60 billion. It had a massive impact on people's retirements. I mean, my husband lost like a third of his retirement through some of this because it has such an impact on the stock market. Computer Associates broadly reported financial results. So did Enron. Health South, that was our former governor's company, was an executive there. They overstated performance by $4 billion in false entries. Quest Communications, $3 billion in false receipts, and the SEC fined them $250,000. Most of the executives here were criminally convicted, but that is only since SOX. Prior to that, those guys walked out free. And when I say SOX, I mean Sarbanes-Oxley. Okay, was Congress's reaction to an awful lot of fraud. And then Xerox, this was back in 97, 98. They overstated their revenues by $3 billion. But so this is the type of thing that accounting could have headed off. Number one, if it caught it, and if it, followed through on stopping it. So what went wrong? A failure of individual character and a culture of greed and ethical indifference. Okay, culture of greed, I think we still have this today. I think it's still an issue. So guidelines for behaving ethically, that you identify a decision by using your personal ethical standards. I mean, this isn't anything that difficult to teach in school. You can show people what could happen and mimic a situation, but the individual has to have a standard of honesty and fairness. And identify the consequences of the decision and its effect on others. How will other people be affected by this is really important. Consider your obligations and responsibilities to those who will be affected by your decision, and then make a decision that is ethical and fair to those affected. Okay? That's a very general guideline. Now we've got different opportunities. Accountants are in different places in the whole business scheme of things. You can, if you're hired by a company, say to perform an audit and prepare financial services, then now accountants employed by a firm, by a business or government or a nonprofit organization, that's considered private accounting. Okay, that's one way to put it. It's also called corporate accounting. And public accountants who have met a state's education, experience, and examination requirements can become certified public accountants, CPAs. I was a CPA for a while, and I don't practice anymore, but it was really fun, and it was kind of like a continuation of school, where you start with a group of people your own age. It was really a great job. More fun than you think it would be. Now these are some accounting career paths. These starting salaries are actually pretty close. In private accounting, where you can be, say a bookkeeper, but if you graduate from college, you're not a bookkeeper. All right, this is like a 2-year program degree. But a cost accountant, internal auditor, IT auditor, you could be an accounting analyst. Analytics are very big in accounting now. And there are different certifications available, like certified payroll professional, a CMA, certified management accountant, certified internal auditor, certified information systems auditor, CISA, that's a very big credential. There are a lot of those. And those in public accounting, all right, have to be CPAs. That's where you get your CPA credential. All right? Now, generally accepted accounting principles are, how can I say it? These are rules that we follow to prepare statements for others. Okay, and they're more or less conventions. There are tons and tons of rules in accounting, really hard and fast rules, but there's still a lot of room for interpretation. So we're governed by the Financial Accounting Standards Board, the FASB, who actually reports to the Securities and Exchange Commission. Okay, so the SEC has authority over the accounting and financial disclosures for a company whose shares of ownership or stock are traded and sold to the public. And you know what? The FASB, they don't really report to the SEC, they report to Congress. Okay, and then Congress also appoints the SEC, though they fund them more importantly. Now, companies outside, or if you have, let's say that you've got a public company and you're not in the United States, then you use International Accounting Standards, IASB standards. And there aren't really a lot of differences between financial GAAP, generally accepted accounting principles, and standards by the IASB, but there's still a little bit different philosophy almost behind it. There are over 150 countries that use international accounting standards, and there is just us who use generally accepted accounting standards, okay? But it's important because it affects the stock market. Now, just a couple of accounting things in here. One of the first concepts is the business entity. And that means that the entities of a business are recorded separately from the activities of its owners, creditors, or other businesses. So even if you're a sole proprietor, if you have a business, you buy a car, that car is your personal asset. It is not a business asset. Okay? So you wouldn't, for example, have the business pay for it if it was your personal asset. Okay? You want to think of yourself and the business as two separate entities. Forms of business entities. Make sure that you are familiar with the characteristics of these. The first is the sole proprietorship. That's 70% of the businesses in the United States. Easy to organize. Resources are limited, though, to those of the owner. You can't bring other people in to give you money, because then it becomes a partnership or maybe a corporation. And it's used by small businesses. For a partnership, you need 2 or more individuals, but this could still be really huge. Like you think of Alibaba, Alibaba is the is the Amazon counterpart in China. That is owned by a partnership of 30 people. Okay? 10% of the business organizations in the United States are partnerships, and limited liability companies are in that number. Okay, so you might have a person who's really good at finances and another one who's really creative. So those 2 people together would form a good partnership, okay, with different skills. Now, a corporation is organized under state or federal statutes. It's usually state, okay, as a separate legal taxable entity. Corporations generate 90% of the business revenues in the United States. They account for 20% of the business organizations. An ownership piece is called a share, all right, or stock. And the nice thing about a corporation is that you can attract capital. You can, raise capital from other people. And this is used by large businesses. And then finally, a limited liability company, an LLC. 10% of the business organizations in the United States, okay, with partnerships. It's used as an alternative to a partnership because it's got certain tax and legal liability advantages for the owner. Okay? Your liabilities, like with the corporation, the individual is completely protected. With an LLC, you've got some of those protections, but with a proprietorship, you are personally liable. Now the next concept, so first the entity concept, this is the cost concept. And under cost, amounts are initially recorded in the accounting records at their cost or purchase price. So this publishing company purchased a building for $150,000. And then we know that the seller listed it at $160. The first offer was $140. The purchase price was $150. Estimated selling price in 12/31/2019 was $220, and the assessed value for property taxes is $190. But what does it go on the books for? It goes on for the purchase price, $150 for the cost. All right, almost there. The cost concept also involves objectivity and unit measurement concepts. So objectivity means that the cost that's recorded has to be based on objective evidence. It can't be your cousin that gave you the value for something. It's got to have objective evidence. And the unit of measure, like in the United States, we use dollars for a unit of measure. But if you're working on a multinational, that can get more complicated. Last slide, and it's another cost concept example. This repair service extended an offer of $400,000 for land that had been priced for sale at $500,000. Then they accepted the seller's counteroffer of $460. On October 20th, it was assessed at $300 for property tax purposes. On September 4th, a national retail chain offered them $525 for the land. So what should the land be recorded on the records for? $460. Okay? That was the purchase price. Under the cost concept, the land should be recorded at the cost to the company. Okay, that was a little bit of a lot of different topics, and we'll start to work with some numbers in the next presentation.